Welcome back, everyone. I'm absolutely thrilled to guide you through today's explainer. Now, we aren't just going to sit here staring at isolated numbers today. Oh no, we're going to trace the entire chronological accounting life cycle of a manufacturing enterprise. We're going to follow a product from the very second we buy the raw materials all the way to that exciting moment we actually recognize revenue from a sale. So grab your notes because we are covering a lot of ground. And I promise you, by the end of this, the whole manufacturing process is going to make perfect, logical sense. Here's our roadmap for this session. We'll start with raw materials and tools, move on to fixed assets, tackle payroll, dive into manufacturing costs, and finally, wrap things up with sales. Let's just jump right in. All right, Section 1, Raw Materials and Tools. Let's get right into this first stage and figure out how we gather the physical resources we actually need to kick off production. Okay, so first things first, we've got to strictly distinguish between our resources here. Account 152 is for our raw materials. Think of these as the actual physical substance of our product, like the steel or the fabric, plus the fuel that keeps the machines running. On the flip side, account 153 is for tools and supplies. These are the instruments that just help us make the product, like hammers or reusable packaging. Now pay attention to how we determine the cost when buying these. The total cost includes the purchase price plus freight, but, and this is absolutely crucial, any trade discounts we know about before receiving the goods, those are deducted immediately from that initial cost. So once we actually get these materials sitting in our warehouse, how do we calculate their cost when we finally issue them to the factory floor? Well, we have 4 standard inventory cost flow methods. Specific identification is absolutely perfect for high-value items where you track every single piece. Then there's first in, first out. Good old FIFO. This one is great because it keeps your closing stock closest to current market prices. Then we've got the weighted average methods. The periodic version is simpler, calculated at month end, making it ideal for high-volume goods with really stable prices, think something like flour. But perpetual weighted average, that one is recalculated after every single receipt. It's a bit more work, but it's perfect for modern accounting software that needs real-time precision. Now, here's a crucial point. What happens when we issue tools and supplies to the floor? Do we just expense them all at once? Well, it really depends on their value and their lifespan. For low-value, short-term tools, let's say a pair of fabric scissors, we expense those immediately and entirely. Bam, straight into account 627 for factory overhead. But for high-value, multi-period items, we have to use deferred allocation via account 242. Take Tuan 2 Textile, for example. If they issue fabric stamping molds worth 30 million VND that are estimated to last 24 months, we definitely don't take a 30 million hit today. That would completely skew the books. Instead, we divide it up and amortize 1.25 million VND into our expenses every single month. Moving right along to Section 2, Fixed Assets. We've got our materials and small tools sorted, but now we have to account for the massive long-term investments in factory capacity. 30 million VND. This number is incredibly important, guys. Under regulatory guidelines like Circular 45 and 147, for a tangible item to officially be classified as a fixed asset, meaning it goes into account 211, it absolutely must satisfy 2 strict criteria simultaneously. First, it's got to have a useful life of over 1 year. Second, its cost must be at least 30 million VND. If it misses even one of those criteria, it's just a tool and supply under account 153. No exceptions. All right, let's test that logic with a quick brain teaser. Imagine Fuquay Plastics buys a small office printer for 8 million VND, and it has an estimated useful life of 2 years. Is this a fixed asset? Think about it for a second. The useful life is over 1 year, right? So condition 1 is met, but the cost is only 8 million, which is way below our 30 million threshold. So no, it fails the test. It gets recorded as tools and supplies. But ask yourselves this. If they later upgrade that exact same printer, so its total historical cost hits 35 million VND, does its classification change? Keep that in mind as we go. Now, during its life, a fixed asset, say a big automatic cutting machine, is going to be steadily depreciated, usually on a straight-line basis. This shifts its cost into our factory overhead month by month. But what happens at the end of its useful life? Well, disposing of a fixed asset is a very strict 2-step accounting process. Step 1, you've got to de-recognize the asset. You clear out its accumulated depreciation and its original cost and move any remaining net book value right over to account 811 as an other expense. Then, step 2, you record the actual transaction. This means paying for any dismantling costs and recognizing the proceeds from the sale as other income in account 711. The difference between those two steps, that's your final gain or loss on disposal. All right, section 3, payroll and deductions. We've got the materials, we've got the heavy machinery, and now we need the human workforce to actually operate them. Accounting for payroll isn't just about recording wages. It's honestly about managing strict statutory contributions for social, health, and unemployment insurance, plus trade union fees. And this perfectly illustrates the division of responsibility. A total of 23.5% of the salary base is recognized as a direct expense to the company, so this gets charged to our cost accounts, like 622 for direct workers or 627 for factory staff. However, another 10.5% is withheld directly from the employee's own paychecks. It is absolutely vital that you structure these journal entries correctly, otherwise you're going to end up overstating your company expenses, or even worse, underpaying your staff. Section 4, manufacturing costs. This is where the magic happens, on the factory floor, where our materials, machinery, and labor all finally come together. In standard manufacturing accounting, we accumulate our production costs into 3 core buckets. Account 621 captures direct materials, so the raw physical ingredients. Account 622 captures direct labor, the wages of the line workers actually assembling the product. And account 627 is manufacturing overhead. This one catches literally everything else in the factory: machine depreciation, supervisor salaries, the factory electricity bill, you name it. But here is a golden rule I want you to remember. Absolutely none of these 3 accounts carry a closing balance at the end of the accounting period. They are strictly temporary accumulation accounts. And why is that? Because at month end, we have to clear them out to calculate our true product cost. Here's how the formula flows. All the costs we just incurred in 621, 622, and 627 are transferred directly into account 154, work in process. To find the total cost of finished goods, we take the opening work in process inventory, add in all those brand new costs we just transferred, and then subtract the closing work in process inventory that's still sitting unfinished on the factory floor. That final amount is then transferred to account 155, finished goods. It's just a perfect logical pipeline. Okay, but what if we make more than one product? Let's say we manufacture both plastic baskets and plastic tubs. Direct materials and direct labor, those are easily traced to each specific product. But how do we split the shared factory electricity or the machine depreciation? We have to allocate account 627. So if we have 42 million VND of overhead and we choose to allocate it based on direct labor costs, which let's say total 70 million, our allocation rate is 60%. We then apply that 60% to the specific labor cost of each product line. But challenge yourself with this. What if we decided to use direct materials as the allocation base instead? The rates change, the final unit costs change, and ultimately our entire pricing strategy changes. It's a huge management decision. Finally, Section 5, sales accounting. We've built the product, it's sitting in finished goods, and now we reach the best part, delivering the goods and actually recognizing our revenue. Now, you cannot just book revenue the second cash changes hands. I know we all want to, but under Vietnamese Accounting Standard 14, or VAS 14, revenue is recognized only when all 5 strict conditions are met simultaneously. And the most critical one? The significant risks and rewards of ownership must have transferred to the buyer. For example, if you deliver goods worth 500 million VND, but you give the buyer an unconditional 30-day right of return, those risks haven't fully transferred yet. That condition is unmet, which means you cannot recognize that revenue today, period. Even when we do finally recognize revenue, sometimes we, unfortunately, have to reduce it. We use account 521 for revenue deductions, and there are 3 very distinct economic realities here. First, a trade discount. This is a commercial incentive given for bulk purchases, like giving a distributor 5% off for buying 20,000 tubs. Second, a sales allowance. This is a reduction given after delivery because the goods are slightly defective, like letting a customer keep tubs with surface scratches for a lower price. And third, sales returns. These happen when faulty goods are completely rejected and sent back due to a breach of contract. Each of these scenarios requires a very specific journal entry to properly reduce our recognized sales. So, as we close out the period, we guide all these numbers right to our income statement. We take our total sales revenue in account 511, and we subtract any of those deductions from account 521. This gives us our net revenue. Then, we match that against account 632, the cost of goods sold that we calculated way back in step 4. Net revenue minus cost of goods sold equals our gross profit. This flow is what ensures that our financial statements accurately reflect the true economic benefit of all our manufacturing operations. To wrap up today's explainer, I want to leave you with a few synthesis questions, kind of like your homework. Think about why accounting standards insist on historical cost for inventory. Consider how choosing FIFO versus weighted average during a period of inflation physically impacts your reported profit. And ponder what happens to your product cost if you aggressively shorten the useful life of a fixed asset. The mechanics of accounting literally dictate the story a business tells the world. Thank you so much for your incredible focus today. Take these questions, analyze them, and I will see you in our next explainer.